Hey everybody, and welcome back to the Bear Trap Discord podcast. My name is John Kirby, my co-host is Vic. All chart credits, as always, go out to Ak. This is a pretty classic podcast in the sense that we're just going through all the charts that we normally do and trying to figure out what's going to happen in the month to come. It was no coincidence that both me and Vic, we had Cem Karsan's recent interview with TD Ameritrade in the back of our minds, so we were breaking that down as we went through our own analysis. We hope that these forecasts, thoughts are useful to you guys, and I'll see you in the next one.
Sorry, let me get rid of that. And then we're
First
looking
off,
at...
let's just say everything we talked about in the last pod that never got uploaded, pretty much, for the most part, played out this week, wouldn't you say?
Yeah, I will say, I don't know if we talked about this, but Friday, for me at least, was a little more upside than I expected because, I had that 1% or so in mind, but then I think what happens is, they start squeezing the puts and then people jump on the call train because they're like, oh, this is a surefire trade because the puts are getting squeezed. And then it just kind of does double what you think it will. That always happens to me.
Yeah.
At least.
Well, so that's interesting because the initial upside into VIX-X wasn't near as much as I thought. So maybe it came in at the end of the week instead. I don't know. But I thought we would at least try to push over 400 to really get the bait going.
Oh, well, I thought that too, actually. Yeah, because I remember we were talking about it and we were thinking about 410 as a distinct possibility.
Yep.
And then, but the
Didn't
thing
even
was,
try for 410.
No. It was a little bit easier once we knew that it was VIX-X to be like, okay, we didn't get it. We just got 400, we'll live with that, as opposed to having that target like in your head and just waiting, and
here's
then never getting short in time.
Right. And the short week, that threw me off a little bit. So I was sitting there trading VIX-X like I thought it was Tuesday, like the first half. So, don't make that mistake, obviously. But so that threw me off. That's probably why my initial thinking of more upside was probably way too high because I thought there was a Monday and a Tuesday to trade.
I mean, but that kind of goes into something interesting, which is that sometimes you have these sort of rhythms and biases that are just built in to your, and it can be these sort of arbitrary things because, I remember that feeling actually of, because I got out of my inventory of short puts, which I've been bag holding for like a month or whatever on Tuesday before VIX-X. And it felt weird because usually I'm used to doing it on Tuesday, like on a normal week type of Tuesday.
Right. Yeah.
Because I've done this, like 4 or 5 times already. So I'm like kind of used to that rhythm. And so it was counterintuitive. I'm with you there.
That's interesting. Yeah. No, that's it's just funny how it happens though. It's once you learn the market rhythm of like VIX-X and OPEX and these big expiries and stuff. It's almost like this is all there is. You know what I'm saying? Like, man, is this all that we've been trading all these years? It's just trading these little mini cycles.
I think about it like that. I think there are many cycles, and then there's a disruption every once in a while, right? Like,
yeah, every once in a while. Yeah.
Jem has been talking about, hey, how we could get the gamma squeeze to the downside.
Yep.
Coming soon, right, to theaters near you, and I think it's gonna just take it's basically like the stars have to align quite literally, right? Like we have to get a catalyst plus a vulnerable regime in just the window right before an OPEX. Like it has to be just vulnerable enough to get us underneath the first wall of hedges, and then the whole damn thing can start to unravel. But we just haven't had that perfect aligning stars moment yet, so it hasn't happened, and it may never happen. And he pointed this out in his most recent interview, where the guy was asking him, "Oh, okay, so we're going to go down then?" He's just saying, "No, this is just a window of vulnerability." Right?
Yep. Yeah, window. He's basically saying it's the same thing every time where it's going. Right now the short vol regime may come to an end. When he thinks in the next 6 months. He's been saying in many interviews that he thinks it's going to be end of February, maybe mid-February. It kind of starts, but there's that window right there where that's going to be the window he's targeting. Does it happen then when nobody's hedged anymore because they're just not going to buy vol again? Especially I was thinking about this too. Is like especially into the summer, right? Where summers are usually pretty low volatile, anyways.
That's a good point. I think if you were to point to what is the biggest difference between uh, January open interest and February open interest, so like this past month versus the future month, you couldn't point to very much because we had a very similar structure. The big difference is not on the open interest charts at all, it's in the implied vol space. And it is that VIX is sitting at around a 20 handle. And I think that might be, stupid as it sounds, that might be what he's looking at. Because
Yeah.
you need a VIX around a 20 handle to have that sort of like the how would I almost put it? I almost put it like the lack of Vanna sensitivity at the right part of the distribution. So does that make sense, or should I
Yeah.
explain that?
No, keep going with it though. But yeah, it makes sense to me. But break it down more.
Okay. So what I'm trying to say is, if we have all of these, like let's say we have all these puts, and then we start to try and make a down move, usually implied vol is going to come up. If implied vol is too high, in other words, we're oversensitive, let's say we're trading at a 30 VIX, it's going to go up to like, say, whatever, a 36, maybe 35 if you're lucky. And on a percentage basis in the vol world, um, that isn't necessarily enough to get put holders enough bang for their buck, which means that it's going to be in your favor to liquidate puts unless you really think an Armageddon is coming and we're going to go to a 40, a 50 VIX, which is never likely. But if we're trading at a 20, the beginning of that move is small enough, right? You go from a 20 to a 21, but it's almost like vol has way more room to ramp up, which means that you can really, really get going.
So you're looking at it like VIX has a range, and for you really to get the like second leg down or whatever, VIX would have to be a lot lower, right? Either 20, 18, 15.
Yeah, I think it has to start lower because what has to happen is all the holders of those original puts that started making money on them, they
Mm-hmm.
have to be happy not selling them and just rolling them down, rolling their profits or whatever.
Right.
And in order for that to happen, it's like, yeah, you can't be near. I mean, it's in the same way as we look at, there's barriers in the, the GEX creates kind of lower and upper bounds. These are almost, I think the upper and lower bounds on the VIX are almost more solid in a way because they're
Mm-hmm.
bounds on pricing, right? It's saying,
Mm-hmm.
if I say vol is over or underpriced, to me, it actually means a lot more than to say the market is over or underpriced because
Mm-hmm.
the market is subject to whatever somebody's willing to pay for it, right?
Mm-hmm.
And that can be any range of numbers. But volatility, we have a very, very concrete, realized sort of, I mean, I'm not sure exactly how to put this. At some point, and I've used this analogy many, many times, at some point, the insurance that you're paying for is going to cost more than your house as a whole. And so that gives you a very, very clear upper bound as to what you should be paying for insurance.
No, that's and this goes back to what I've said before is the VIX sort of acts like what you would use an RSI for.
Yeah.
But for demand for insurance, portfolio insurance is sort of the way I think of it. And I think that's how you're putting it in a good way. There's an upper and lower bound to how much this insurance is going to cost.
Yeah.
Right.
Yeah, and I think some of that is historical, right? Like I think we didn't know that there was a lower bound to the VIX until we had Volmageddon and people realized, oh, if the VIX is this low, it's because the short vol trade is crowded, which itself is a risk factor, right? That's sort of a market reflexivity type of point. But
Right.
and then the upper bound is, like I said, set by, how much does your house as a whole cost? If you have no portfolio left to hedge, you're not going to pay for hedges anymore. You're not invested. What do you care?
Yep. No, and that's the way you got to look at it too, and that's why it's so important to look at the VIX look at the VIX GEX positioning or open interest or whatever. Because why would VIX expiration be important then if the VIX positioning doesn't matter?
Yeah, I mean that's something that I still haven't like. I totally agree with you at looking at the VIX as a sort of RSI, and that VIX positioning matters. It's been, I mean, I've seen it matter over and over again. One thing I still don't understand though is from a notional value perspective. If we're thinking, hey, money is
Yeah.
king,
Yeah,
what
you're
the
right.
VIX
Like,
is nothing.
yeah. You're saying, okay, it's got 50 million GEX on the 20 handle VIX, and it's controlling what, $1 trillion worth of movement in the market. You know what I'm saying? So yeah, I get what you're meaning too. It's like, how is this even important? And I think it's what other folks are thinking too. Is like, why would you look at the VIX as anything as far as its positioning? Because it's not the same thing.
Yeah, and I mean, I think there's something there that I'm missing, which is that VIX options are probably tied to something else like credit default swaps or, some other type of, variance swaps or something like that, which they're probably an indicator of something else that I don't quite understand yet.
And that is such a good point, because if so, for example, if someone out there knew that there was going to be a Lehman Brothers type of event, wouldn't you think that would reflect in the volatility in the VIX structures, the term structures themselves?
Yeah, it should. Yeah.
And the notionals would probably be a lot higher as far as total dollar value.
Yeah, and
Uh,
we've seen that as well. I mean, I didn't pull VIX-OI, but just based off of looking at this GEX, like I remember, because I was looking back at this back when we had the Ukraine and all these crises, we would have VIX-X's where we're having like 400,000 contracts worth of OI on a given strike, and I don't think we're anywhere near there. I think we're at like 100,000, 200,000, so like half to a quarter of that.
Yep,
Um,
exactly. Well, and that's another thing too, is you go, okay, well, if your theory is right here, okay, volatility, the implied volatility of the market or the implied demand for SPX put options is super low notionally, and the GEX positioning is on the pointing to the downside on it, then what is VIX? It's just the next 30 days, right? We're just extrapolating out what the market thinks of the next 30 days. We have a huge expiration coming up in 5 days or even 4 days. So how can you possibly be, just based on the data, how can you possibly be bearish into that? That's sort of the thesis I came into the week with.
yeah.
Tell me what you're thinking about that.
Well, I think you mean in terms of, well, I think that it was easy to be bearish on Wednesday
Oh
simply
yeah.
because we had the VIX puts expiring, and I mean this is not the right chart, right? But there was a lot of them, and it was funny how the market just like ping ponged precisely depending on which puts on which side were expiring.
Yep.
Um, and then on Friday, just had a ton of SPX
You're fine.
puts expiring, and both in the AM and the PM, and then all the SPY, and then all the individual tickers as well. And so it's kind of unavoidable at that point. I was thinking about this from the perspective of like a trade, sort of thinking, okay, well, if I know that those things are probably going to be worthless on OPEX, why don't I just go up and put on a calendar where I sell an OPEX expiring put, and then buy a put for the window of weakness. Um,
Mm-hmm.
and I think that would be a viable trade if you hedged it with a further out of the money put on OPEX itself. Because the funny thing about OPEX is that if we were to get a disastrous event on OPEX itself, like we would have a liquidity break, I think,
Right.
right?
Oh yeah, for sure. No,
I
you're
don't
right
see how
about
we
that.
wouldn't. If we have 2 trillion notional expiring on a day, and then all of a sudden you have a giant ass move and we're offsides. I mean,
Mm-hmm.
where are they getting the now 4 trillion, now $6 trillion that they need in order to compensate? It wouldn't work.
Yep. Yeah, it's just not there's just not enough liquidity in the system for that to happen. And I think I think you got a situation where, like, well, I guess if some big fund decided they wanted to crater everything, they probably could have, but why would they? Why? What incentive is there for something
Yeah,
like that?
exactly. Yeah, the incentive is not there. Um, all right, so I stand corrected. Looking out at if you combine well, not entirely. If you combine March and February 15th VIX expirations, you are looking at like 300,000 on a little over 300,000, 350 maybe of open interest for the 30 calls.
Yeah, so that's again. So now it's super interesting because during that last little VIX cycle, it was VIX short VIX, and what Jim was saying in his interview was we're probably going to see a situation where you just be open to it essentially with VIX going up for this next cycle
Yeah, and
and the market up
seems like they're positioned for that. Yeah.
and market up too. So that's going to throw a lot of people. I don't know. I'm not going to say a lot of people off. I'm going to say FinTwit's going to be thrown off from what I read. If that situation did occur, it would be, obviously everybody would be like, well, this is probably the top. But, if you use the VIX to trade, the correlation may change where VIX down, market up and now it's VIX up, market up. And
And
last
that,
year there was a
it
while where it
makes
was
sense though.
VIX down, market down. So, just be open to that is that's the way I'm looking at it, is like, okay, if that's the case, then we could see 25, 30 handle on VIX and market trading 400 something.
Yeah, and I mean, if we think about it from the perspective of a sort of cycles of inventory, so to speak, right? It makes sense that a lot of people were loaded up in hedges for the new year. So like December, January, all that stuff. And now we've just seen all of those hedges get unloaded. And that's what we've been seeing over the course of the last month or two. And now that vol is cheap because all the hedges have been unloaded, it's time to start stockpiling inventory again, not just for now, but maybe even for the summer or something like that. Not
So
all the way the summer, the
you're
next few
talking about
months.
VIX calls or SPX puts, essentially. People are buying
Yes,
puts.
I'm
Yeah.
almost imagining like literally that these big boys have a warehouse, a
Hmm.
warehouse of options. And they don't want to buy too much at any one point to move the entire market. So they're slowly adding, and then they'll add and subtract in cycles, kind of like we know how the JPM caller operates. And
Sure.
so I almost imagine, maybe in Jem's head, he's thinking like, what the reason that he's thinking that was going to be coming down this entire time and get so cheap for the end of the year was that's the cycle that all the big boys use. They hedge on a yearly basis, or they think it's one of those stupid things, but that's probably
No.
what it
It's
was.
no. It makes sense. Yeah, and I sort of think of it that way too. It's like, okay, I like your analogy there, a warehouse, or you could think of it like a car lot full of cars, cheap cars. People are, they've just got their parking lot's just full of them. I just think of it like, okay, I'm looking here and I'm going, well, there's a big supply of VIX open interest sitting here at 25 and 30, whereas the last cycle there was just a ton of it's the same thing. So here's what I would think here is like, okay, where's the GEX going to be in relation to this situation? If the GEX is still pointing to the downside, then it's likely, and right now it's kind of mixed. But if
But
it,
this is more call heavier than we've seen it in a long
for
time,
sure,
despite the fact that it's mixed. Yeah.
for sure. And so we're definitely loaded to the upside on the VIX, but it's going to depend on where the GEX leads it. I think, like, if the GEX is again pointing to the downside, uh, you're going to see some more VIX going down, meltdown. That's the way I would look at it, because that GEX is going to start pulling. It's going to start pulling the market, pulling the VIX away from those positions. And as we get closer, then obviously we know what happens as those positions start to expire. That's the supply again, where it's like, why buy into just such an oversupply of calls, fixed calls. You know, you wouldn't buy there. You would roll, or you would buy into the next quarter, but it won't have any effect yet until you finally get through that VIX-X.
Yeah. Yeah, no, I see what you mean. In a weird way, it's almost it's a very odd analogy to like the way that monetary policy is working right now, where it's like, okay, we've pumped a ton of liquidity into the system, now we're slowly draining it out, but nobody really knows when the point will be at which it'll be sufficiently drained, sufficiently tight. Sorry to mix metaphors there, that like we'll get some indication of that. And
Yeah, and I don't even care about that anymore. I mean, it's like trying to time when this big moment's going to happen. I think it'll be evident
yeah,
if you're just looking at this stuff every day like we do. You're just going to go, okay, it's extremely vulnerable right now to something. And what I'm seeing right here, we may get some fake outs to the downside. I would definitely not be surprised about that, but I don't see an event. You know, obviously an event can occur, a tail event, but I don't see the positioning set up for that. Do you?
no, I mean, if I look, and this was something that surprised me because I thought that people were going to be sick of puts already, but it looks like,
No, they just
I'm
rolled them
looking
out
here
again.
at, they rolled them out again, so they're there keeping us up. One thing that they did do though is that they rolled a little further down. So I mean, I'm looking at this. You remember that we in our previous podcast, which has yet to be released, unfortunately, we were talking about 390 as that
390, yeah.
downside target, the
Mhm.
DEX level.
Yep.
And I think I have the delta hedging as well. It's a little messy because we're towards the beginning of the month, but I would say that it has moved down to 380 over here.
Yeah, look at that. Wow.
So I mean, this stuff in the middle is messy. Like I wouldn't necessarily read too much off of this DEX chart. I mean, maybe you can. I can't see anything here, but all I can see is that that is the biggest level on the chart.
No, messy is definitely the word for it. In the near term, you know, the deltas are exposed to the downside. So if you see negative GEX, then you'll probably see some down moves to coincide with that. But having the negative delta down there, that's interesting to me. You know, combined with the positive delta that you have in the
Exactly.
short term.
This hollow right here is just asking to be filled because
That's
that's how
sort
I
of what
see it
I'm
anyway.
thinking. No, and
Right?
I sort of think that too, but you'd have to wait for either a positive to negative GEX day, or you'd have to wait for some negative GEX to show up to pull it down into those exposed areas. So if you think about what GEX is, right, it's just the sensitivity of the deltas, but the price has to get down there too. But if you did get some big negative GEX on like a 390 or something, you're probably going to 390.
Yeah.
You
No,
know, and maybe even overshoot it a little bit. But man, that would be annoying, wouldn't it? If we stay in this, like, just hovering above this 385.
I mean, I think that, and this is more of a sentiment issue, but after Friday, I saw some raging bullish talk on FinTwit.
Yeah,
Um,
Jem warned about that too in his interview. He said wait for folks to start saying Goldilocks, you know, like Goldilocks bullish conditions, you know, those kind of things. He's I don't know if those words are going to show up, and if they do, then he is definitely some kind of seer, you know, psychic. But it's like, I think what he's trying to say is like you're going to be in a situation where it's like you're never going down again type of talk, and
well,
that's
we're starting. We haven't heard Goldilocks zone or anything like that yet, but we are hearing some of that talk. And I've seen a lot of tweets to the effect of, and they're rightly noting that there has been rotation out of defensive sectors into more risk-on sectors. And I mean,
for
this
sure.
positioning started, they're kind of late to the party. This positioning started in big tech a little
Right.
while back. That's why you're seeing, Google,
Mhm.
Amazon, even these really beaten up FANG stocks start to break out of what looked like a never-ending
By
fall.
the way, did you get some positions on Amazon started? I know we were talking about that a month or so ago with
Um,
how do I evaluate Amazon? And
oh, we were. I mean, I sold puts on it,
yeah, okay, yeah, good.
and I got out of those, and then I tried selling a call on it, and then it made me feel a little bit not comfy, so I got out of that for a small loss, and now I have nothing.
Nothing.
That
Yeah.
is one thing I regret sometimes is sometimes I feel like I should just wait to get put, and then just keep the shares for a bit.
Oh,
But
interesting. Yeah. So instead of closing it, just say, okay, either make me buy it or sell it, for example.
yeah,
So
because then a lot of times after, because I always sell my puts for OPEX itself.
right.
And then a lot of times after OPEX, we get a transition anyway. So if I'm going to get put, and this is kind of a side conversation, but um, maybe useful for those of you who want to start selling some premium to kind of know when you should be selling it for, because it's not arbitrary.
No, it's definitely not arbitrary. Not the way you're doing it. I mean, using the cycle and using the positioning. Um, I would say it's just a matter of we could probably systematize it better, but it's about knowing who's exposed and essentially how much time they have, how much time they have left, you know, to get paid out. So if you know there's a
Yeah.
bunch of puts about to expire, then all they have left to do is just to unload the puts
Well,
for a
and you
couple
kind of,
days.
I think you have to try and see it coming in a little bit, right? So if you look at the SPY net open interest, you can already tell that, by Feb 17, and this is so I also listened to that Gem podcast and or I guess interview, and he was basically talking about bullishness, about green shoots um, coming up soon, and I can
Potentially.
yeah, potentially. I can see why, because we're in the middle of a combination of two things. One is we're having these slightly more bullish indications with inflation coming down a little bit or being more normalized. We know what the Fed is going to do. Most people probably think that that's already priced in to some extent. And then you still have this sort of bearish negative gamma structure, which has a tendency, it just means that if the bears, anytime that the bears are not getting catalysts in their favor, then they're
They're
in
going to get
trouble.
screwed. Yeah, because you
Yeah.
got to think about the catalyst that they have to have now versus the catalyst we've already seen that have essentially been repelled, right? Like we've had threats of nukes, we've had Apple shutting down stuff, lowering guidance. Um, just think about everything. Tesla basically crashed 50% in like 2 months. And none of that took the market below. Yeah, at least recently, it didn't really even go below 380 very long. And now we're sitting here, and what could possibly happen right now? What's out there
Yeah.
as a tail event? And what Jim was saying, and I know you remember this too, is he was saying bearish sentiment is at 2020 lows, is at the COVID
Or
2020
highs.
lows.
Or yeah, the sentiment is as bad as
The
it was
bearish
at the
sentiment,
yeah, yeah,
exactly. Yes, that's what I meant to say. So it's like if we're already at COVID 2020 bearish lows as far as sentiment goes, I mean, what could possibly take us much lower? And if positioning is set up that way too, then I always kind of look at it like we got to sweep the bears out first. Okay, whatever bear traders or funds that are in here, trying to take the market down, fudding it every day, those guys got to get blown up first. That's the way I kind of think of it because you know they're just causing the market to go higher.
that being said, them getting blown up first, just based on all this positioning and the decks and all of that, like we could still see, I think, correct me if this doesn't sound right to you, but a move down to 380 or 385 without, without any of those puts really getting paid properly.
And that's what I said when I look at that dex and I look at this, I go, I mean, I don't think we're done with 385 and maybe even
No.
380 tags, but it's like that's about as far down as I can see us. We could probably just hover there. But what I mean by it
Well,
being
and
annoying
I
is
hope that,
because I
yeah,
would like to get
sorry.
up into the 410. That way we could get some decent sell action. Um, have some really nice, limit down scares. You know what I'm saying? And still we still hold above those super bears that are sitting there at 380 and 385.
Yeah, no, and I feel the same way, to be honest. I'm a little annoyed that that's all we're gonna get to. But yeah, in terms of timing, what I was thinking of is um, I guess we'll go from a VIX analysis a little bit to a gem analysis. But I was talking with Tux a little bit about this, and um, Gem was pointing to a lot of these catalysts, upcoming catalysts. So um, whether that's GDP or CPI or jobs or whatever that are coming up sort of end of January.
Yep. Sorry, that's my kids running around upstairs if you're hearing that.
No, no worries. But because what those things do is they raise implied vols beforehand and then they collapse it afterwards. And so if there's too much bearish positioning, even going into those events for any reason, even because it's bearish positioning for the end of the month, that's those sorts of movements and volatility are what allow the market to squeeze back up. But on Friday was OPEX. In other words, we got a lot of them moved, a lot of those puts off the table, and we're inside the window of weakness, and we don't have any events until the end of the week, and we don't have any relevant events until next week. So I was just thinking, if there's any time to make a break down to 385, 380, that is Monday, Tuesday, Wednesday.
I love it. I
Thursday.
absolutely love it because I think it makes perfect sense. And what I've always noticed in my, short time trading is the market likes to make these moves when there's no news,
Yeah.
no events. And then it's selling off. And then you start hearing the narrative of like why it sold off, or they'll throw an event out there or something for the reason. But there's always a bearish narrative. So there's always a reason for the sell. But you always see it. You always see the sell. The only other issue you got is earnings coming up. So there's no news or events really, but there's earnings. So
That is true, and I was taking a peek at some of those. I know we don't usually do this, but let's see.
you got
They're
like
all
ServiceNow is coming out in a couple days. Tesla is coming out in a couple days. What we got? Some big semiconductors are coming out.
yeah.
Boeing,
Well, Microsoft is Tuesday, so
Microsoft. Yeah. I mean, Microsoft looks like a short to me. Like I can't even describe it. I don't know why, but I'll have to validate that. But um, I saw some positioning on that. Nothing to the upside, as far as I could
interesting.
tell. Yeah,
Well,
so
yeah,
that's interesting. So if you get the sell, it would come off the back of something like that, right? A Microsoft dropping 20 points or
yeah, and there's your headline.
yep.
Worse than anticipated earnings create, lead to,
You got
you know,
ADP coming out. ADP is a big one. That one may be one of the biggest ones this week, in my opinion. What I want to see, because they're aren't they payment processing? Or am I thinking of
I
a different stock? I could be thinking of a different stock, but
I have no idea.
yeah. So
Um,
for unemployment purposes, I think 80, yeah, automated data. I think they're part of human resources. So uh, they come out with employment numbers, I believe, and so they'll talk a lot about employment, the employment
and so they're
situation.
they're going to front run the jobs report.
In a way, it'll be a tell for the jobs report. I think the market might interpret it the same way, where it'll be like, well, okay, if jobs are going to be super strong, well, what is
Hmm.
that going to imply? Well, there's no recession yet, which there's a ton of stuff saying there's no recession anyways. And what's that going to end up doing to rates or inflation for that matter? And so you can get some reads off of ADPs as far as for the economy. And
Well,
that,
the other thing to mention in that light, right, is that not only are we getting earnings, but we'll be getting forward guidance, which is actually a lot more relevant because
for
we're
sure.
probably, and we saw this with Netflix a little bit too, right? Like it wasn't a phenomenal announcement, but we still got that pump up.
And
Um,
that's bullish. I mean, I think I said that in the Discord, like, okay, if Netflix squeezes up, that's your tell.
and
And
you were right about that, yeah.
Netflix sold off on Tuesday while the market was kind of hovering. And I was like, well, here's your tell for VIXX because it sold
They
off. It's Netflix is literally, I don't know what it is, but Netflix, you should always keep it on watch because it's it's like a leading, I don't know, some kind of secret Wall Street thing or something, but I swear, whatever Netflix is doing, whatever it does on earnings is a tell for the rest of the season.
I mean, the other thing that they do a lot of the time, and Tux has noticed this, and this sounds too simple to be right, but if the earnings are going to be good and the stock's going to pump, it'll sell off
beforehand.
And the reverse is true as well. And the reason for that's actually kind of simple, and it's that um, if you want to make money off of the earnings, then you want to buy it for cheaper. And so you might as well initiate some selling intraday, and then you can buy it back for cheaper overnight when a lot of the retail and pension funds and all of the so-called normies aren't playing the game. And then when it pumps, you have more access to it because a lot of times it's pre-market or after hours, the announcement. So it just makes sense.
No, and I totally like whenever I saw Netflix sold off right before the end of the day, before earnings release, and I was like, okay, this is so fake. I can't even. I don't know why I can just tell. It just goes to your point where it's just like after a while you just start to know. And I had this idea it was probably going to like 340, 350, and just based on the positioning, the skew, and that kind of stuff. I was like, well, should I buy some right now on this sell? And I didn't, but once it pumped, I was just like, okay, well, if Netflix isn't going to sell off of these bad earnings, hold on a second.
No worries.
If they're not going to sell off these bad earnings, then how can the market sell? Why would the market sell? What could take us down? And because it's just a reflection of what's going to happen in the earnings season too. I think you're going to see.
Well, and they did it again on Friday when that Fed speaker came out. I think it was Harker or Williams. And we took a little bit of a breather, and then they used that excuse as, okay, now we're going to start the actual pump, and then it just blasted off for the rest of the day.
I saw something too, just these little things you pick up, where it was like one of the Fed speakers was like, the market's perception of the fund's future rate is pretty spot on, and so if basically he's typically what happens is they come out and they'll try to say something to crater the market or pump it up. But he just said something like that. And I think it was meant to pump it because it's like, well, if the perception is right, then what's going to happen to volatility? Or, what's going to happen to people's hedges in a sense. And so I interpret it as a very bullish statement to say that. If he says that the market's perception is basically what we're pricing in futures. And if he's going, well, that's pretty much spot on, then, there's no surprise there, right? There's no uncertainty.
This is true. At the same time, what is absolutely bizarre to me is that they have been telecasting their plan for such a long time and been relatively consistent. I mean, there have been a couple changes along the way, and then the futures are pretty. It almost seems like a non-statement, but you're right. It's a statement that removes uncertainty. But because the other point is, shouldn't the markets have more confidence in the markets than confidence in whatever the hell one of these guys is saying? Because they don't know what they're going to do.
They should, but that's just a game, man. It's just a game they've played for who knows how long. I mean, we know for many decades, where you're going to have the market expectations out there, just like someone makes their estimates for earnings. And then you're going to have, the Fed's forward guidance come out.
Yeah.
And each one has, I don't know how they do this, I don't know the game well enough, I guess, but each one has like a role they play, it seems like. One comes out, they had a role, the other one comes out, they're saying, I don't know if they're saying their true feelings about what they think.
We should write like like an operetta, like a little play or something. And
yeah. And well, so yeah, each one has a role, and one's the bad guy, one's the bad cop, one's the good cop type of thing. I don't know if that's how they're really playing it, but he comes out and he says a non-statement, or basically saying, hey, the market's right now. Don't expect rate rate volatility. Okay, and well, that right to me goes, okay, buy all the calls in the market right now, because there's no what's the risk? There's no risk. I can't perceive a risk from that statement. If he came out and said, well, the market's way off, we're pricing in 5% and we're closer to 8%, well, what do you interpret that statement as? I'd be like,
Yeah, but
holy
also each one
crap.
is really only, well,
Well,
yeah,
it
no,
doesn't
fair
matter
enough.
what each one is, how important that guy is. All that matters is that headline that shows up on your screen,
Yeah.
and you go, what's your thoughts of what everybody's positioned for one thing? They're positioned for 5% rates. Their discounted cash flows are for 5% rates, and it just trickles through the market. And then all of a sudden he goes, well, there's
That's
this
actually
outside.
true. That's another way to put it, is to say that everybody has been making decisions according to correct information, which itself is a huge boost to markets. Because if
Exactly.
I'm a company and I'm deciding, oh, am I going to lay off? Am I not going to lay off? And then in all my Excel spreadsheets, I'm using a 5% to discount or whatever to do all my budgeting and so forth, and it's more likely that I'm going to be right, then it removes inefficiency from the markets. So that's
And
actually a really good point.
it removes it makes people more comfortable, like you're saying, and then the perception that the market is right, that's going to suppress volatility, because the implied volatility that might be there is just because of the uncertainty. And so once the markets get some more certainty, the IV compresses. But like I said, like he comes out and says, well, there's an outside chance of 8%. Well, that throws all kinds of red flags up,
Hmm.
right? Because then that's signifying like tail event type stuff.
I mean, if he had done that on Friday, that would have been really bad.
Right. So think about what he did. He came out and basically just removed all risk from traders' minds, for at least for that day, and given the positioning that was already out there, something seriously crazy would have had to happen to take the market down again.
Yeah.
Because at least at that point on Thursday and Friday, it was just like, well, I think it was I don't know what time he said that, but we had a little blip right after lunch on Friday, and then I came on into the chat and I was like, just buy the 39.40 call. And I didn't do it like an idiot, it was like 250 or something. And then the thing runs to like 32 for the rest of the day. Because it was like I was just reading the little tea leaves there. It was like, well, there's no volatility, there's no risk, there's $5 trillion expiring today, or whatever the number was. He was like, this is just a little fake out after lunch.
Yeah, that was the time to do it too. So then we have this, little window for some downside without anybody really getting too messed up by it. And then it looks like we would have a nice little couple weeks of upside. And then what happens? What happens in before February 17th, before the next OPEX?
Man, Oclocracy, man, he called this. Before Jim's interview, he was in there going, I think it's probably around February, and I think he was just going for that OPEX at timing. But and he said something about it always happens around Valentine's or whatever. And I thought that was interesting that he said that. And then we watched the Jim interview, and he's saying, basically that Valentine's timing for, it's just going to be that window. I think we've had so many quarters and cycles of just what I would say is puts being cleaned up. Like an old regime is just slowly dying off. That's what I kind of think of it as.
But in order for this whole thing to work out, we would really need to see a pretty decent rally first, right? Like we need the rally before the OPEX to clean everything up. And then on the OPEX, we need to have a ton of calls expiring, essentially.
Yeah, exactly. So you hear the term Goldilocks. That may be what he's talking about, is the Goldilocks for the bears, because you're going to have CPI around that timing. I'm not sure if FOMC, I haven't looked out that far like I should have. But, you're going to have this timing where it's going to be just it's going to be all bull, and then the rug's going to come. It could come. It may come. It probably will come. Here's something that he said though, is you'll probably see the rug then, but if vol is controlled, like we're not seeing some crazy spikes, then you're probably going to see some more melt up, some more short vol situation, which I thought was interesting. He threw that in there because it was like, well, okay, so we're basically just bullish for the rest for the rest of the most of the year then, if that's the case.
Well, it might be one of those cases in which I know the statement that you're talking about. Basically, like, if we just end up getting, it makes sense. If we just end up getting some like consolidation after a move down at that time, then it's almost like there's so much pressure to get us down after everybody has seen that vol constantly compresses, because it's just scary to be holding puts for too long. It's almost like there's a second order effect here, where all of a sudden the requirements for holding onto your puts are so much higher because you've seen them die over and over and over again.
And this is where I go, this regime that's here. And the only reason I keep saying this is because I just listened to a podcast about how the market is just regime change to regime change to regime change. And it's like, well, we got this situation where there's a huge group of banks, traders, institutions, or whatever that have been short vol. And you got a whole bunch of people that have been trying to buy puts and seeing them die, even with the market going down. At some point, that's going to shift. It's just like that's when you're going to get the huge liquidation event or whatever.
But maybe the reason that Cem's having such a hard time is because predicting that is the equivalent of predicting a bubble bursting, which is, as we know, really hard to do.
A bubble bursting. The bubble is short vol.
Yeah.
Because it's such a crowded trade that, yeah, eventually the short vol will burst, and it'll probably be like a COVID 2020 type of situation again, and then short vol will come back again.